Anglo American has slashed its dividend. The diversified miner has declared a final payout to shareholders of 41 US cents. This takes the total for the year to 96 US cents, which means that the dividend has more than halved from last year's amount. This follows a 94% plunge in annual profit as Anglo had to contend with weak prices and higher costs at its diamond, platinum and iron ore businesses. Anglo says that while there is no doubt that the immediate macro picture presents some challenges for its PGM and diamond businesses, the demand trends for metals and minerals have really looked better. Anglo American has also announced that it has agreed to buy and integrate Vale's Serpentina project with its adjacent Minas Rio mine in Brazil. Under the deal, Vale will contribute Serpentina and over $157 million in cash to acquire a 15% stake in the enlarged Minas Rio mine. Anglo CEO Duncan Wanblant says the move allows the miner to secure a high-quality iron ore resource and opens the door to potential access Vale's rail and port logistics as well. The transaction is expected to be completed in the fourth quarter. A dip in output and higher costs have caused Goldfields' annual results to lose some luster. The miner has posted a 21% decline in headline earnings. That's as attributable gold production fell 4% and all-in sustaining costs jumped 17%. A final dividend of R4.20 has been declared. This takes the total for the year to R7.45. Looking ahead, the Goldfields has raised its 2024 output forecast to between 2.3 and 2.4 million ounces. That's as it takes into account its new Salar Norte mine in Chile, which is set to begin production in April. Salar Norte has faced several delays, but it's key to Goldfields' long-term goal of raising output to about 2.8 million ounces annually. Mondi says it has delivered a resilient performance in 2023. The packaging group has reported a 35% drop in underlying EBITDA, but cash generation has remained ahead of last year's figure at 1.3 billion euros. The group says this gives it the strategic flexibility to continue investing in the business. Mondi is hopeful about the year ahead. The firm is seeing improvements in its order books and is implementing price increases across its range of paper grades. And while input costs remain elevated compared to historical levels, Mondi says costs have broadly stabilized since the end of 2023. Pick n Pay is looking to address its financial woes. The retailer is embarking on a rights offer with the aim of raising up to 4 billion rand. It says the move will take place in the middle of the year and forms part of a two-step recapitalization plan. The second part involves listing its Boxer discount chain with an IPO set for the end of 2024. Pick n Pay says the plan aims to stabilize the group's balance sheet, strengthen its liquidity and provide capital funding for long-term sustainable growth. Investors will have to comb over Blue Label's results with a fine-tooth comb. The telecoms group has presented interim results peppered with asterisks as the recapitalization of Cell C has skewed its numbers. For the 6 months to end November, core headline earnings per share jumped to 47 cents, but this includes positive contributions in the current period and negative contributions in the prior period. If those are stripped out, core HEPS declined 23%. Harmony expects to shoot the lights out. The gold miner has forecast that its interim headline earnings per share will surge by more than 100%. The firm has described the result as stellar and says the performance has been underpinned by higher recovered grades, an increase in output, and a rise in the average gold price received. The group will open its books on the 28th of February. Further afield, Boeing has announced that it is immediately replacing the head of its troubled 737 MAX program. This decision marks the first significant executive departure since the January 5th incident involving a mid-air panel blowout of a new Alaska Airlines MAX 9 aircraft. Here's more detailed in this package report.
The head of Boeing's 737 MAX program is leaving the company. That's after a door panel broke off of one of its MAX 9 jets in midair last month, sparking a fresh crisis for the plane maker. The MAX program leader, Ed Clark, had been with Boeing for 18 years. He'd overseen production in the Washington state facility where the plane involved in the incident was completed. Clark's departure is part of a larger shakeup, including a new senior position for quality and safety. Regulators have curbed Boeing production, and the company's been closely scrutinized by lawmakers and clients since the January incident. A memo announcing the shakeup from CEO Stan Deal said Boeing was working to ensure that, quote, every airplane we deliver meets or exceeds all quality and safety requirements. The panel blowout had happened on a brand new Alaska Airlines plane. It forced pilots to make an emergency landing while passengers were exposed to a hole 16,000 feet above ground level. The panel serves as a plug on some 737 MAX 9s instead of an extra emergency exit, but the one on the Alaska Airlines jet appeared to be lacking 4 crucial bolts, according to a preliminary report earlier this month. The report also said the door plug in question was removed to repair rivet damage, but there's been no evidence that the bolts were reinstalled. The findings angered Boeing's airline customers, with some, like Alaska Airlines, announcing plans to implement stricter quality checks on planes before they depart the Boeing factory.